Archie.
Let's take this opportunity to talk about your Quantile model, because you've gone to all the effort to build it. Tell us what made you want to build this model, and what is the foundation for this model that makes it different from the others?
Yeah, so it's been quite a journey with this model, and it's actually been a lot of conversations with a lot of very smart analysts, and it's been kind of a collaborative effort. So a lot of people might be familiar with the power law, and the power law was discovered by Giovanni, I believe. I can't remember the exact times, but I know as far as the price relationship with log price versus log time, or log price versus log price versus hours since the Genesis block, or hours since the Genesis block. That was in 2018, I believe he discovered that. So I kind of came across the power law about just over a year ago. And at the time when I came across it, all I could see on it was basically Giovanni talking about it. And I looked at it myself, and I've been studying Bitcoin now for 5 years full time. I got a top subscription to Glassload for a couple of years. I was looking through all the on-chain data, all the metrics, and I kept coming across this kind of pattern where there was it looked like a diminishing return pattern for the actual peaks of a lot of these metrics. So a lot of these indicators and metrics, I was like, okay, they're interesting, but the pattern seems to be that we don't necessarily get as high on some of these metrics. And so how do you assess where we're going to actually get to, and how do you kind of deal with that? So that was in the back of my mind, but essentially looking at all the on-chain data. And then when I came across the power law, I was like, okay, this is interesting. This is different. This is more of a statistical pattern. But at the time, there was essentially just a line like this drawn through the data set. So this image is actually, it's looking at it. The chart in front of you is log on the y-axis, right? So that's the log of price. The x-axis is in linear. And I do that because visually it's more intuitive for people to understand. Otherwise, you get a straight line and you're compressing time with log. So it's unintuitive to humans because we perceive time linearly. So initially when I saw this power law idea, Giovanni was showing these charts mostly in log space. So it was a straight line. But it was hard to kind of interpret and visualize as somebody that's looking at linear time as a human. So you can take the actual underlying data of log, and you can convert it into log linear, so it's easier for people to perceive it. So that is actually a big advantage. The other thing was there was essentially just a line through the middle, kind of like a fair value or a mean. So he was using something called an OLS fit, but it's essentially a line through the data. But there was no way to kind of quantify how far you're from that midpoint and actually model the top half of the data set. Because the power law is very useful for modeling the bottom 50% of the data set, but it's actually not that useful for modeling the top 50% of the data set. So there's a big distinction there. And
when you say the lower end of the data set, are you talking about the lower price range within a cycle?
What I'm talking about is, so for example, on this chart right now, this line that's drawn through here, I didn't draw this. This is a statistical regression. This is something called quantile regression. So it's actually the median. So it finds the best fit through the middle, essentially, of the data set, and it's more robust to outliers. So there's two different fits you can do, main fits. There's a median fit and a mean fit, right? One is an average, and then one is the median, or the middle value. So this is the median. So and what this does is it's essentially, you could say this is fair value. It's a way of looking at the fair value, because you've spent an even amount of days above this line and below this line.
I see. I got you. Yep. Okay.
Yeah. So half of Bitcoin's, if you look at all the days, so actually look at hours. So I look at hours since the Genesis block. So it's over 133,000 data points, and it's hours. So half of those hours we spent below this line, and half those hours we spent above the line. But it actually doesn't overweight the extreme peaks, whereas a mean is an average. So it actually kind of overweights all these extreme peaks. So this, to me, is the best way to look at it, is the median, because it does capture the true pattern and isn't as affected by the outliers in the data set. So when you have this is kind of the foundation. So this is when I stumbled across the power law, this is essentially what I was looking at. was a line like this, but in log space, which was what Giovanni was. It's more of an observation. The power law is a great discovery. I give obviously Giovanni credit for that. It was an observation, but you still have to build a model around it. And you still have to say, does it represent the full data set or just the bottom? So it really well captures everything below this line, but it isn't that useful above this line. And because it doesn't factor in something called a decay function. So basically the power law is an important observation that when you understand it and you combine it with other patterns, there's another very important pattern with Bitcoin, which is the decay function. When you understand that, you can actually build a true model around it. And that's why the Quantile model is unique, because it's a full integrated model beyond just the observation of the power law. It makes it actually useful. And it makes it so that everything is based just on statistics, and you can say the exact amount of days you've spent at every level, and you can quantify it. So yeah, I hope that makes sense. Was there anything?
No, that makes perfect sense to me. So where do we take it from here then?
Yeah, so I'll just kind of walk through what I did, and then we can go to the main visual. So with this one, what I essentially do is I start with this median quantile regression, right? And then from there, I actually remove all the data above this line. So I remove all the data above this line. And the reason why I do that is because I want to isolate the bottom 50% of the data, and I don't want the top 50% to influence, because there's two very distinct patterns happening here. There's what's called, you could call it the power law, or linear quantile regression is another way of phrasing it. But essentially, it's that pattern for the bottom 50%. And so that's more the long-term stability kind of adoption. So if you look at Bitcoin, I'll just explain it this way. If you look at Bitcoin, it's a network of networks is one way to think about it. And it's a network of networks that is stabilizing over time as it goes through its adoption curve or adoption cycle. So as it's gaining adoption, it's gaining more and more stability. The market cap's growing, there's more thicker order books, lower volatility, bigger players entering, more stability of the overall network. And that's not just the price, that's also the hash rate, that's everything. Everything to do with Bitcoin is growing in stability as a network, right? And so as that's occurring, right, as that stability is occurring, that is essentially what the power law captures really well mathematically. It captures this long-term network of network stability growth, and it follows a specific pattern. And so what I do is I remove all the data above this line, and then I actually run another one of these median quantile regressions on just the bottom 50% of the data, right? So the data below this line, I run another median quantile regression on that. So you can imagine another line kind of going, through this bottom 50%, right? And the reason why I do that is I want to capture the true pattern of the bottom 50% of the data. And when I do that, you can take that, and then you can basically take what's called the slope and intercept. So it's essentially the mathematical pattern of the bottom 50%. You can take that slope, and you can, I actually do 500 fits for the bottom 50% of the data. So it's 500 different quantile regression fits, all using the same slope. And the reason
what's a fit, Plancy? What's a fit?
So basically, you can use, from a statistical standpoint, you're essentially like quantile regression. Okay, so quantile regression, you're taking, how to best define this? I mean, it's all based on math, right? So I'm obviously not doing, because a lot of people are used to TA. So they're used to people drawing lines on charts, finding support levels. This is completely different. None of this is related to specific patterns, that people use with TA. This is all math-based. So it's essentially finding I'm not finding the fit myself. I'm putting in the code, right? There's actually 1,500 lines of code that go behind the Quantile model. That code is basically telling the computer to run all the formulas. So it's the one running all the formulas and determining this is the best fit, right? So this is capturing the pattern. So that's essentially what these fits are. Depending on what type of fit you're doing, it's a statistical mathematical fit. And just like you would, here's a simple example, right? Like one fit, say you have 10 people's ages, right? And they all have different ages. Well, if you wanted to find like the median fit, You'd find the median fit of those 10 people. So this is obviously more complex than that, but it's the same principles, right? So it's not like it's debatable. It's like, no, this is the fit for this type of regression, right? And so does that make sense? Or maybe I
Sure.
explain that?
Yeah, using a statistical method to find some kind of some kind of trend within the data set.
Yeah, exactly.
Fit,
yeah,
right?
exactly. You're using math and regressions to essentially assess, are there patterns here, and to what degree, do we have these patterns? So there's a lot of different ways you can do it, but essentially this is very simple actually. Like from a regression standpoint, this is pretty straightforward at this point. So we slice the data set in half. You could say remove everything above it, which is more it's not so much the core trend, it's more these bubbles on top of the core trend, right? And then you have the core trend underneath, and then by doing a second regression on the core trend, you can find the middle point of that pattern. And then you take that, and what I'm doing is I do 500 different fits. And the reason why I do that is because I want to have one for every 0.1 quantile. So it's just a personal choice of precision where I want to be able to say for every 0.1% of the data set, I have an actual fit in the line that I can use. So for the bottom 50%, 500 fits, right? And so they all share the same slope. And so it's impossible for those lines to ever cross. So let me just pull up one more chart here. So it's actually important because essentially with quantile regression, some people say, okay, well, what happens if the lines cross? They can actually never cross statistically. It's impossible at any point in the future. So I've actually designed it that way specifically that they can never cross. And so that's actually, I'll pull up this chart here. Okay, can you see this on the screen?
Mm-hmm.
Oops. Okay.
Yeah, we've got 4 spikes.
Sorry, this one. Yeah. So once I find that core bottom trend, and then I apply that to the 500 fits, what I do then is I take that middle line that we had in the last chart, and I do ratios of everything above that. So with this chart, if you look on this side, these are the ratios of the price and how far it got above that median fit, right? That the line we're looking at in the last chart, I'm doing a ratio of every data point above that and looking at it in terms of a ratio. So you can see this is way back in early days, right? But we actually got extremely high here. This was, say 28 or so times higher than that median value. And then you can see it's gone down. This cycle went down to roughly 15, and you can see it went down to roughly 7.5, and you can see it went down again to whatever this would have been, say like 4. So there's a clear pattern. I mean, I can tell people, like, this is the thing. People get more engagement when they just present hopium, right? They say, okay, Bitcoin's going to $1 million a cycle or whatever. It's tough as an analyst that's actually just looking at the data and honestly trying to convey it. That still, of course, wants to get a lot of engagement, right? Everyone wants engagement. It's fun. But at the end of the day, this is the pattern. No one can deny this pattern. This is a clear decay function of Bitcoin. I hate to break it to people, but the diminishing returns idea on the extreme peaks above the core trend of the power law is a clear downtrend. Now, could it break? It's theoretically possible. It does appear to be a clear pattern, but it is still a limited amount of data points. And there are caveats. If the US dollar breaks as a denominator, that could completely change this, of course. But will the US dollar break in the next few years and become like a third world currency? Probably not. It could happen, but probably not. I think it's still going to take a while, at least a decade or more. You can also denominate Bitcoin in gold, and that's another way to do it. And I want to work on a quantile model versus gold. I think that'd be useful. But as long as the US dollar remains stable, this pattern continues to play out, right? You can see where we are here. We're just barely poking ourselves above that median quantile regression. So yeah, I don't know what your thoughts are on this. This is probably, some people would say this is a bearish chart or whatever.
It's not really bearish because, okay, it shows diminishing returns, right? So that's been a clear pattern. But what I wonder is now, do we reach an inflection point where all previous trends are broken? As Michael Saylor's famous for saying, all your models are broken. So that, there's quite a clear trend in what you've modeled there. And I see that in a lot of models. I guess before anybody presents any of their work, they need to be able to see a trend that's worth sharing, right? But At what point do these models break down, or what would falsify them? What would demonstrate?
Yeah, for me, I mean, to falsify. So I have two main patterns. I'm not attached, like the Quantile model is completely agnostic to the length of the cycles. So you don't need to factor in any lengthening of the cycles. What I primarily look at is what quantile we're at. And there's a lot of value with that, because you can actually say what percentage of the time have we been above this point. And you can actually quantify specifically based on all the hours since Bitcoin's, since July 17th, 2010, when it kind of first started trading on Mt. Gox. So as far back as we have access to reliable, useful data, this incorporates it all. And so my biggest thing with this is what quantile are we at? And this gives a good reference point within the data set, regardless of where we are within the timing element of the cycles. Now, as far as saying, this pattern breaking, there's two main things. So the bottom 50%, right? So with the blue and the gray is 1 to 20 quantile, and the blue is 20 to 50. So these bottom two bands represent below that midpoint, right? So 50, you could say 50 is fair value, right? And I put deep value for the gray. I called the blue discounted, because it is discounted. It's below the fair value, you could say, or the median of the regression. The yellow is I call it premium, because it's essentially above that fair value point. Right now we're at 56, right? So we're just a bit above that. That range goes all the way up to 80. And then above 80, you start to get more in just kind of a speculative point where you could still see big returns, but there's also increasing risk. And then the very top, you have that gray where we've always peaked, and that's the top 5% of the data set. So we've had 4 peaks or 5 peaks, we had 2 in 2021. So 5 times we've got to that top gray band, and essentially that's been the peak. And Bitcoin only spends 5% of the time there by definition, because it's above the 95th quantile. So the two patterns going back to it is that bottom base. So those bottom two bands, like 50 quantile or lower, that's the core. You could call it linear quantile regression or power law trend line. That's the adoption curve. That's the long-term pattern for Bitcoin. So I'm confident in that. There's really good math to support that over the last 15 years, and it actually keeps growing in its R squared in its strength. So the bottom two bands are seeming to be very solid. The 3 ones above it represent the decay function. So that is the best fit, essentially, to model that. So I do 499 fits on the top 50% of the data set, all the way up to 99.9 quantile. And that's capturing every 0.1 quantile, and it's best capturing that decay pattern we saw in the last ratio chart. And it's actually a very good fit as well. Everyone talks about the power law and how great it is, but if you're using what's called an exponential decay or a stretched exponential decay, there's 2 different versions. This model actually runs both of them. So the code actually runs exponential decay and stretched exponential decay. They're very, very similar. It runs them both, and it actually determines which is a better fit based on different tests and statistics. So essentially, what it's doing is it's combining those two patterns. And so, and I did quite a bit of research on networks that follow power laws over long periods. And they actually are very common to see the majority of the time with exponential decay and stretched exponential decay. It's actually the most common pattern that's found if you look at a lot of the research. So I thought that was super interesting, because that's what we see here. We do see those patterns together. And if one breaks, I think both will break. So that's what I haven't heard anyone else really talk about that. But I do think that if either the decay function pattern to the top breaks, then the power law, in my opinion, is probably broken as well. And if the power law breaks, then of course the decay function is also going to break. So they're both interdependent, and everyone's focused on the power law, but the decay is very important. It's actually a result in a way of the power law, or they're kind of interconnected. So I don't know if that makes any sense.
It makes perfect sense, and you've explained it extremely well. The question I have in my mind is, you spoke about potentially the models breaking. Have you given much thought about the potential scenarios that would give rise to these models breaking?
The biggest one is just the denominator, the US dollar, just losing its ability to hold stability. That's my biggest X factor, is simply the US dollar collapsing. But I tend to lean towards that's not going to be in the near future. It's going to happen at some point. All currencies essentially do fail at some point, but yeah, I don't see that happening in the near future. And again, you can model this in gold, and it's different, but it still holds some of the same principles. It still has that power law and decay function elements. It's not quite as clean, but you can still model it versus gold. So as far as what would break this, I mean, it would take an insane white swan to the upside. It would take something that is way beyond or 10x more than anything we've ever seen, but it has to be proportional, because every cycle it takes something way more significant, because it's always relative to where you are in the growth and the adoption. So we need a white swan so significant, right? Hopefully people understand white swan, opposite of a black swan. So an unknown that is so bullish that we just blow through the top of this pattern. And if we blow through the top of this gray line somehow and stay above it, I'll be the first to admit that decay function is no longer valid. It's going to take something pretty extreme for that to occur. Of course, same thing. If we spend, a significant amount of time, months, and trading well below this bottom band, then yeah, I mean the power law is broken.
But I'm just looking at your chart right now, and at the top end where it says historic peaks 95 to 99, part of the quantile model, right? And that's well below 300,000. And we've got 2 years to run on your chart up to 2027. So a lot of people are predicting, Bitcoin could quite well run up to 200, 250, sometime early to mid 2026, for example, right? And that goes dangerously close to breaking your quantile model there. Are you saying that that's extremely unlikely? Is that what your model is suggesting?
Well, this top, just so people understand, this here, this number is the 99.9th quantile. So by definition, we only spend 0.1% of Bitcoin's historical hours at this level. So, that is, what would that be? So that would be 130 hours we've ever been at that level. So those are extremely short-lived periods. So that is the peak of the cycle. Those are very hard places for anyone to be selling. We're talking about like the most extremes, right, at the very top. But if you look at the whole band and you look more in this kind of range, right, if we kind of look at it more as a range between 95 and 99.9, I mean, these are reasonable numbers that I think, are achievable, but not just pure, fantasy or hopium. I mean, it's just like, okay, so for example, right, and this, I think in a lot of ways for me, like this sort of a model builds conviction in holding Bitcoin long term. Your core conviction should just come from understanding what you're holding and just researching Bitcoin, at least in my opinion. That should be kind of the core conviction. But this does also help in the way that for people that like looking at the math and things, it gives at least me more conviction, and it also sets realistic expectations as well, because I think it's important. So for example, for anyone who thinks this is bearish, I mean, the median value in 5 years is 515K. So basically we're looking at, you could say a 4.5 to 5x on just the fair value of Bitcoin over 5 years. Now, it might not be as much as some people want to hear, but a 4.5 to 5x over 5 years is good returns. And again, these extreme kind of peak points. Yeah, like what are your thoughts on this? So essentially, say 9 months from now, that's middle of next year, 227 to basically 300,000. Yeah, if we go to 500K in the middle of next year, this model's broken. At least, but
even less than that, I think there is a risk of Bitcoin going, well, maybe not 300,000 within a year, but that's I give that like a 5% chance. But okay, those numbers are different to what I'm looking at on your chart, because your chart's got a top limit of 300K, and then time-wise it stretches to 2027. So that's
Oh yeah, no. You got to look at
Okay, I'm looking. Okay, gotcha.
Yeah, this is for the the actual chart itself. This is this. So don't look at it in that way. Look at it more in this row is based on today. This row is 3 months from now, and then this is 3 years. So you have to kind of do your own calculations.
Gotcha. Yeah,
so maybe that makes more sense now. Right?
Yeah, it does. I mean, yeah, in a year's time, do I think Bitcoin's going to be 316 100,000, I think, yeah, probably a 5% chance. I think that's about right. I think
to
that's
get to the
right.
top band. So yeah, if the cycle does extend, say another year, and say we end up peaking at the end of next year, just as an example, to think Bitcoin could be between, say, 240 and 300 or something, it's reasonable, right? 250, 240 to 300 range in a year from now, definitely reasonable. Nothing too insane, but yeah, these numbers, like people say, well, where's the $1 million Bitcoin? Well, it's not here yet, at least on this chart, because this chart looks 5 years into the future. I didn't want to model beyond 5 years. Some people will, but I actually, with statistics, if you have 15 years of data, going out 5 years is a reasonable period to model out as a ratio, because you have 15 years of data, you're modeling out 5 years. It's a 3-to-1 ratio of data to projections. If you start projecting out 10 years, I would argue you don't necessarily have enough data to do that, and it's kind of irresponsible. And so I think 5 years is a good amount of time to be projecting and no longer. But every day that goes by, this is 5 years into the future. So this number will tick up because it's, all these are projecting into the future, these lengths of time. So these change as we increase our days, and everything will change. But basically, the 1 million Bitcoin for this top band, it's with this model, it's within the next 7 to 10 years is more of a what this model points to. So yeah, that's just the data. I mean, I'd love to tell everyone we're going to get there sooner, and we could. I mean, maybe this is completely wrong, but I'm pretty confident in this. To be completely honest, I spent months developing this, and I do think it's one of the best, if not the best, kind of investment frameworks. It's not a trading model. I don't advocate trading, just so people are clear. I'm not saying go out and leverage trade with this. I definitely don't want people doing that. It's a tool for long-term conviction and just understanding what the data points to, and then you can have your own interpretations of it, or whatever. You disregard it, or you have your own theories, or you kind of watch to see if it'll break or not. But I think it's a useful framework for most people that just want to hold long term. And if you want to take some lifestyle chips off the table at some point, say people got in really early, or they've been in the market for 10 years or whatever in the future, and for whatever lifestyle reasons they want to take 5% or 10% off the table or whatever of their stack, they can at least assess what kind of value they're getting relative to the data set. So if they're selling above the 80th quantile, you're like, okay, I'm getting a decent amount of value. I don't want to be selling down in this 20%, this bottom band, right? You're getting low value for Bitcoin. Some people, of course, would say never sell. You're never getting the value if you sell to another asset. But I'm not talking about selling to another asset or trying to sell to get back in. I think that's a dangerous game, because anytime you sell, assuming you can try to get back in lower, you're taking a huge risk that Bitcoin just doesn't come back. And we could never go back down to this bottom band for all we know. We could just stay in these 3 middle bands, and everyone waiting down here for this bottom band, it might never come. We never actually got down to the bottom band during this bear market, right? So right here, we actually found support at the 20th quantile. Back here we were in the bottom one, but it was actually COVID that brought us very briefly. And these are short-lived periods, so maybe you can't get in here. So, yeah, it's a tool that, like, again, long-term conviction, understanding long-term patterns, just based strictly on math. No extra narratives, no extra hopium. It's just pure math. And then if you want to sell for something, lifestyle-wise, like really upgrade your life, okay? Because I don't know what your philosophy on this is, but I have a philosophy that the only thing more valuable, well, not the only thing, but one of the things more valuable than Bitcoin is time. Time is actually unknown scarcity. So Bitcoin is known scarcity. There's a certain amount of Bitcoin there'll ever be, and that's scarcity. But it's known scarcity. Time is unknown scarcity, because nobody knows how much time they have left. It's a scarce asset that you also have this curveball that it could end tomorrow. And so that's why I put time above Bitcoin in the hierarchy of value. And so for me, it's actually logical to sell a percentage of your Bitcoin if you can meaningfully improve your life in a way where you can spend time with your loved ones or create lifelong memories with your loved ones.